Assalamu alaikum, my dears. I hope you're doing well. Welcome to the ACCA TX Marathon session. It's day 2. Can you please confirm I'm audible to all of you? Can you please confirm I'm audible to all of you? If yes, so then we can start today's discussion. All right. So basically what we have done till now, we started our discussion with the review of few concepts, and then we applied the same concepts on different questions, and we have attempted 3 scenarios in previous session. So it's basically the next lecture continuing the same things, and we'll also try to do 3 to 4 questions in this session. Without wasting further time, we have question number 3 in front of us. This question number 3 is pertaining to the married couples tax planning. I would be giving you time to read this scenario, but before that, I can't tell what exactly is there. Basically, there is a couple, the husband and wife. They are asking you a thing with respect to the planning of taxes. Currently, the husband is doing business and he's a sole trader. But they are asking you that whether it would be beneficial for the couple to divide this business between husband and wife by taking wife as a partner in the business. So basically, currently existing model is there is only one owner of the business, the husband, and the couple is asking you whether it would be beneficial for couple. Is there any saving in tax liability if the wife joins business as a partner? Basically, the requirement is the overall tax saving for the tax year 21-22 would be. You have to tell about the is there any tax saving by this proposal considering the existing scenario and compare it with the suggested with the planning they are doing. So being a tax advisor, you have to calculate, you have to explain the tax savings for the tax year 21-22. H and I are a married couple. H is currently self-employed and his forecast trading profits for the year ended 5th April 22 is 100,000. Fiscal year 21-22 starts from 6 April 21 and ends on 5th April 22. And that's not the actual profit, that is the forecasted profit for this year end is 100,000. And he's a sole trader, he's self-employed. He does not have any other income. I does not have. I means the wife of the person does not have any income, although she does a considerable amount of unpaid work for husband's business. They are considering to take up this option. The couple wants to know if it would be beneficial to form a partnership from the start of this fiscal year, with the profits being shared 75% to husband and 25% to wife. Existing model is this, and they are planning like this, and they are asking you to calculate would be there any tax saving if they go for this model, if they actually divide this business, if the wife is inducted as a partner in the business. So what will happen then? So before attempting this question, I'm actually giving you 5 minutes time to think that what should be done, what exactly are the things to cover, how we can respond with respect to this question. For example, there's a question which is in your exam scenario. That is the question, let's say, which is examined in front of you in actual exam. So what will you be thinking at that time? So take 5 minutes time and decide what to do and how we can do calculate this tax saving considering the existing business model and the proposed business model. So your time, your thought process time starts now. All right, so let's start discussing this one. First of all, I'm going to consider the tax implication under the existing business model. First of all, what we should do now is that to consider the tax implication under the existing business model. Under the existing business model, there is only one owner, there is only a single owner, that is Mr. H, and the forecasted profits for this year end. This year end is the end date of the fiscal year 21-22. The amount of profits is 100,000, which is by after all adjustment, that is a taxable trading profit, that is a tax adjusted trading profit, or you can say it as taxable trading profit. Nothing else is given. So in existing business model, there is only one owner, one person, and he is in self-employment. So the person's income would be the trading income. Amount of trading income as per the question scenario is 100,000. In absence of any other income, the same would be considered as total. In the absence of any qualifying interest, same income would be considered as net income. From this total income, from this net income, then we can deduct the personal allowance. We can deduct the whole amount of personal allowance as net income, as the adjusted net income is not more than the 100,000. After deducting this taxable personal allowance, the taxable income is calculated at 87430. As a person is doing business, and the taxable income is calculated as for Mr. H, as we are working all these things considering there is only one owner, and that one owner is only H, and we recorded this income in the head of non-saving column or in the other income column, because the trading income is a part of non-saving income, and any non-saving taxable income, the first 37,700, for the first 37,700 from this amount, the rate of tax is applicable at 20%, 7540 is calculated. Then thereafter you can see that person's income is more than 37,700. So after this taxation, the differential amount of from 87430, if we deduct the taxable amount, the first band limit, then the excess amount is calculated as 49730, on which 40% high rate of tax is applicable, 19892, and the sum of these two is the total income tax liability. Income tax liability for H is calculated as 27432. As we are done with the discussion of the income tax liability, but we know one thing, that we have studied this concept in trading income. If a person is doing business, that person has also to make the class 2 NIC and class 4 NIC, because for self-employed person, class 2 NIC and class 4 NIC both are payable. So class 2 NIC is basically calculated using a fixed amount of 3.05 into, for complete fiscal year, there are 52 weeks, an amount of 159 is calculated. At the same time, so we are done with the discussion of income tax liability, the class 2 NIC, and now finally, as a person is in self-employment, self-employment persons also do pay the class 4 NIC, and class 4 NIC is applicable on the amount of taxable trading profits or the tax adjusted trading profits, which are 100,000 in this scenario. So what we are basically trying to find is that we are actually trying to find the tax liability considering the existing scenario. Then we will be finding this amount again by considering the proposed scenario, then by taking the difference of this existing model and the proposed model, then the difference of these two models will be the tax saving, if any. But as a person is doing business, each sole trader has to pay the class 4 NIC for the first according to class 4 NIC, the first 9568. To this extent of 9568, there is nil class 4 NIC. 9568 is calculated. Then thereafter, the second limit is 50270 minus 9568, a differential of 40702. As per the NIC information, 9% is applicable. 3663 is calculated. 3663 is calculated. Thereafter, now finally take the taxable trading profits. From the taxable trading profits, we have calculated NICs to this extent. So the differential of 49730 is multiplied with the 2% of NICs. 995 is calculated. The sum of all these three values is becoming 4658. So you can see is that if a person is doing business and currently he is the only person which is the owner of the business, then the person has to pay three different things: the income tax liability, the class 2 NICs, and the class 4 NICs. All these things are acceptable till now. Is there any confusion problem? You may please ask. And if you guys are okay, do let me know in the chat box. Your active responses would be highly appreciated, please. Okay, good. So we are actually going to now add all these three things. The income tax liability. Income tax liability for the person is calculated as 27432. Then the class 2 NIC will be 159, and the class 4 NIC we just calculated an amount of 4658. If Mr. H is doing business based on the existing model, then the total cost of doing this business will be the sum of all these three, and the sum is becoming 32249. So basically, under the existing business model, the total cost of doing business is 32249, and the client is asking you what will happen if couple would be making a partnership from the start of this year. Means then this 100,000 would be the income of two persons, and 75% for husband and 25% to I. So hopefully the things we discussed till now are clear. Thereafter, we are going to start now the proposed business model. I have just inserted a page for this discussion, proposed business model. And under proposed business model, there are two persons basically. One of them is H and wife's name is Ingrid. So H and I are the two persons, and now they are sharing an amount of 100,000, the trading profits, into 75% means 75,000, and according to partnership, 25% profit share to wife. So 25,000 amount is given to wife. For H and I, they are getting their trading profits. So both of the income would be the part and parcel of the non-saving column. For H, I'm creating a non-saving column because trading income is reported in non-saving. For wife, again, we are creating a non-saving column. For both of the persons, trading income is given. Trading income for the husband is 75 as per the proposed scenario, and 25,000 is given to wife. In the absence of any other income, same would be the total. In the absence of qualifying interest, net income is given. From this net income, we can deduct the personal allowance. Personal allowance is available for each person separately, and the same amount of personal allowance is also available for wife. Although his wife was already working for his business, but that work was unpaid work. From the start of this fiscal year, they actually have divided their business into a partnership form. They are just treating now. They want to treat this business now as a partnership business. So we are following the things from here and trying to recalculate the amounts, the liabilities for each person under the proposed business model. After this deduction of the personal allowance which is available to each person, taxable income is calculated as 62430, and the taxable person for wife is calculated as 12430. Furthermore, if you remember a thing, if you remember a concept from partnership, from tax perspective, partners are treated as separate sole traders. Partners are treated as separate sole traders. Even they are doing this business in a partnership form, but from tax perspective, each partner would be considered as separate sole trader. What does it mean? Each person has to pay its own class 2 NIC. But before the calculation of class 2 NIC, let me calculate the liability for each person separately. For the first person, to the extent of 37,700, rate of tax is 754, 20%, and amount is calculated as 7540. Then take the difference of 62430 minus 37,700. A differential of 24,730 is calculated, multiplied with the high rate of tax, and resultingly 9892 is calculated. The sum of these two is the income tax liability, and income tax liability is 17432. Same case, wife's income is falling in the basic rate band limit of 37,700. So it means this income of 412,430 is directly multiplied with the rate of tax of 20%. So finally, the income tax liability for wife is calculated as 2486. Let me write this amount again. The income tax liability for wife is calculated as 2486. It means under the proposed model, we have calculated a liability, the tax liability for each person separately. For can you hear me properly? Actually, there was some internet issue. Can you hear me properly? Please do confirm this thing. Am I audible to all of you? All right, thank you. Thanks for your replies. Okay, so we have calculated the income tax liability for both persons in the couple in the proposed business model. Then thereafter, as I told you, from tax perspective, each sole trader, each partner is considered as a separate sole trader. if they are being considered now as a separate sole trader, means now each person has to pay its own class 2 NIC, and class 2 NIC is calculated as same. The amount of 3.05 this person is doing business for whole of the fiscal year, 159 is calculated. Now also the other person is engaged in business activities. From tax perspective, it's a separate sole trader. Another class 2 NIC is calculated for the same person, for the second person as well. Thereafter, we are going to write these amounts here, 159, and for this person a separate class 2 NIC as 159. Thereafter, the last step, as from tax perspective, HMRC does consider each partner as a separate sole trader. If they are considering each partner as a separate sole trader, so the NICs for each person would be calculated separately. By the way, class 4 NIC, as I told you here, class 4 NIC is calculated and paid on the taxable trading profits. So here in this scenario, the trading income for Mr. H is 100,000, is 75,000, and for trading income of his wife is 25,000. As we bifurcated these amounts here, so class 4 NIC is to be calculated and paid on these amounts. From over here, the taxable trading profits are 75,000, and over here taxable trading profits are 25,000. For the first 9568, to this extent of 9568, there is nil NIC. Then thereafter the second limit is 50270, of which to this amount there is nil NIC, and a differential of 40702 is multiplied at 9%, 3663 is calculated. Then take this final amount from the 75,000. We are done with the discussion of the first 50270. Thereafter 24730 is multiplied with the 2% of class 4 NIC, 495. The sum of all these is 4158, and the same case over here for the first 9568 for his wife. For the first 9568 there is nil NIC, and now take the difference from the taxable trading profits amount of 75,000. His wife income is 25,000, from which 9568 has already dealt, and a differential of 15432 is multiplied at 9%. We can say that 1389, so only this amount of 1389 is calculated in respect of the class 4 NIC for wife. We are also adding, we're going to add these amounts, 4158 for husband, and thereafter 1389 is calculated here for wife. Going to add this amount here, 1389. Finally, you can say that if they are doing business in a partnership form, husband has to bear a total cost of, what is the sum of 17432 plus 159 plus 4158, 21749, and his wife also has to pay a sum of 4034. By the way, if you add these two values, when if they are doing business in a partnership form, the total cost for these both persons will be the sum of these two, 21749 and 4034, is becoming 25783. So you can see that in a proposed business model, the total cost for the couple is becoming 25783, whereas in the existing model where the husband was only doing business, in that scenario the cost was 32249, and requirement is to calculate the tax saving by having this opportunity to do business in a partnership form. So you can say that overall tax saving, you can compare these two values. The tax liability before dividing this business into a partnership form was 32249, but if they do this business in a partnership form, the overall cost for the couple, for the husband and wife, will be 25783. So the total cost will be then 25783, and it means you can see that when there is only single owner person, the total cost is more as compared to the when there are two persons are in partnership, the total cost is becoming 25783. It means there is net saving by 6466 if they do this business as per the proposed strategy. as per this strategy, if they are going to divide this business in the partnership form, then they would be getting a net saving of 6466. Is this thing clear? So this is how you have to cleverly think about different things, that what could be the scenario, how we can deal with the things. So we performed all of the calculations based on the existing model. Then we also calculated all of the things under the proposed model. Then we simply compared the total cost under option under the existing model and then the proposed model. Then we end up with the net saving, and we have solved the requirement. The overall tax saving for the couple will be 6466. And now I'm actually allowing you 3 to 4 minutes time to think about, is there any other way around calculation? Is there any shortcut calculation? Maybe yes, there could be a shortcut calculation. Then we are not in need to perform all of these lengthy workings. There is, yes, there is a shortcut to find all of these things. How we can arrive this directly at this total saving of 6466 thing, considering this scenario thing, how we can calculate directly. But this long method would be helping you to solve this question. It will take time, but the error chances will be less. But if you are actually trying to follow the shortcut method, maybe you can save your time by applying the shortcut, but the chances error are higher as compared to this long working. But for thinking any shortcut to arrive directly at this value, I'm just giving you 3 to 4 minutes time. So let's try to decide what we can do in that scenario to directly arrive at this figure. Based on this scenario, what we can do? Please think, and I will start discussing after 3 to 4 minutes. Thank you. Okay, be with me now. Think, as this person is a sole trader, the sole proprietor, the sole owner in the existing business model, if he is taking his wife in the business as a partner, as per this proposed strategy, as he is inducting his wife as a partner into the business, and giving 25% of the profit share. It means the overall profits for himself will go down by 25%. If any amount is going down by 25%, so it means the tax liability would be saved by 40%. For example, if an amount is decreased by, before this proposed strategy, so he was getting a profit of 100,000, but if 25,000 profits are given to his wife, so how much he's getting actually? 75,000. So it means if the 25,000 profits are going down, so the tax liability would be saved at 40%. Yes or no? Yes or no? If the profits amounts are decreasing, so ultimately it will be giving you a relief in the form of reduction in the income tax liability. Yes or no? Yes, perfectly answered. Furthermore, think, is there any impact on the class 2 NIC? Whether he is getting 100,000 or whether he is getting 75,000, is there any impact on class 2 NIC? An impact? Yes or no? No impact on class 2 NIC? No. Jody, we are talking about class 2 NIC. Class 2 NIC is based on the number of weeks for which you are doing work, doing business. It's not dependent upon the profits amount and all that. My question is only pertaining to class 2 NIC, not class 4. So there will be no impact on class 2 NIC. Whether a person is getting 100,000 or whether a person is getting 75,000, whether a person is getting trading profits of 25,000, it will not be impacting the class 2 NIC amount. Whereas class 4 NIC will have an impact due to the reduction in the amount, because class 4 NICs are calculated on the taxable trading profits. If taxable trading profits are now, instead of 100,000, if he is getting only an amount of 25,000, it means taxable trading profits are also going down by 25,000. It means they are gonna save class 4 NIC at 2%, because after this strategy he would be getting 75. Till this, to the extent of this 50270 NICs are calculated at 2%, then instead of 100,000, we will be using 75,000 as we used here 75,000. It means 25,000 amount is ignored here. It means that 25,000 amount is gonna save tax at save NIC at 2%. So basically what we can do is that simply we can calculate what is a shortcut method, calculate the tax and NIC saving, tax and NIC savings for H. How much tax saved? If the H profits are going down by 25,000, he was paying tax at 40%. So 25,000 into 40% is 10,000. NIC saved, if an amount of 25,000 is now not included as taxable trading profits, so they are gonna save NIC at 2%. 25,000 into 2% is becoming 500. So the total tax saving for H is 10,500. Whereas consider the tax cost for I, as she is going to start business. So by doing business, what is the total cost for I? For solving this direct method, the shortcut method, this calculation is simple, although you have to perform all of these calculations for I. For his wife, the income tax liability for new partner is 2486. New partner would be paying class 2 NIC. New partner would be paying the class 4 NIC. So the total cost for this person is 4034. So the total cost for I for doing this business is 4034. From the total tax saved, deduct the total cost, and the differential would be the tax saving. Now you can see that we directly calculated an amount of tax saving, which is becoming exactly the same amount of 6466. But for following this method, for using this method, you should be very clear with the things. You should be very clear with the concepts that how the things will be impacting the taxation matters. If you think that you can follow strictly the impacts of the taxation matters, so you can follow this direct method. Examiner will be giving you the full marks. There is no point to deduct any marks in this short calculation, but you have at least you have to calculate, you have to show all of these workings, that if the wife is joining that business, so the income tax liability, the class 2 NIC and class 4 NIC, these things will be calculated over here. The tax cost of the new person for starting a business, and then from the tax saving of husband minus the tax cost, so the net saving is calculated as 6466. That exactly is the same amount which we calculated above by following the lengthier methods. Is this thing fine? Are you guys okay with this working? Any question, unclarity, please raise your questions. Yes, my dears. Okay. We are done with the question number 3. Now on the next slide, here is a petty question number 4 with respect to the capital gain tax and IHT comparison. CGT and IHT comparison. As I told you, by attempting these questions, automatically all of the taxation syllabus areas will be covered, will be revised automatically. So you can see that in each question we are getting a different scenario pertaining to different taxation matters. So here in question number 4, the question is about the capital gain tax and IHT comparison, and requirement is to tell about the immediate IHT and CGT implications will be, not all of the, but immediate IHT and CGT implications will be. Scenarios in front of you, read the scenario, decide at your own. Please try to sum up few points. Then I'm going to start within the next 1 minute. Please read this scenario very carefully. Okay, on 4th May 21, is in fiscal year 21-22. Daniel made a gift to his son. Son is a connected person for CGT purposes and direct descendant for IHT purposes. I repeat, he made a gift to his son. Son is connected person for CGT purposes, whereas the same son is a direct descendant for IHT purposes. D made a gift gift to his son of 15,000 ordinary shares in ABC Limited, which is an unquoted investment company. Before the transfer, D owned 60,000 shares out of ABC Limited's issued share capital of 100,000. It means before transfer, the person's shareholding worth is 60%. From the 100,000 share capital, he owns 60,000, showing a 60% worth of £1 ordinary share. ABC Limited shares worth at 18 for each holding of 60, 10 for each holding of 45, and £8 per share for a holding of 15%. So basically, at times share prices are based on the shareholding percentages. So now in this question, if the person holding is 60%, the share price will be 18 per share. If the person holding is 45, the share price will be 10 per share. And if the shareholding is of 15%, then the share price is considered as 8 per share. He purchased 60,000 shares for 90,000 few years ago, assuming this is his first lifetime transfer ever for IHT purposes. So you have to tell the implications with respect to the IHT and capital gain taxes, but the implication should be of the immediate implications, not all of the implications. In IHT, if we think the same concept, if we consider the concept according to the IHT principles, IHT says that transferring any asset in life to any other asset, that is potentially exempt transfer. For IHT purposes, if a person is transferring any asset to other person, for IHT purposes, this transfer is potentially exempt transfer, and the PET value is normally calculated as per the concept of diminution in estate. The value of PET would be calculated according to the diminution in estate concept. Diminution in estate means reduction in estate, reduction in wealth. Diminution in estate means reduction in wealth. So what are the relevant steps to follow? What are the immediate relevant steps to follow under IHT? So we have to find the value of PET according to diminution in estate. What exactly is this diminution in estate? So first of all, check the value of asset before gift. Then check the value of asset after gift. And the resulting difference would be the value of gift. And for IHT purposes, as this gift is to a person, it is PET. So we can see that before transfer, the person was holding 60,000 shares. Then he transferred 15,000 shares to son. From 60 minus 15, he still owns 45,000 shares. And basically he transferred 15,000 shares to his son in a fiscal year 21-22. Before gift, he owns 60,000. He gifted 15,000. So remaining shares are 45,000. But what should be the value according to the shareholding percentage? Before gift, the person was holding 60% shares. From 60,000, he gifted 15,000 shares. Remaining 45,000 shares represent a 45% holding. So after gift, worth is 45%. Why we are identifying these things? Basically, we have to decide the value per share. So what should be the value per share? So you can see that when the person value before gift of these shares are of 60,000, so it represents the 60% shareholding. According to the 60% shareholding, the value of this asset is worth at 18 per share. So this 60,000 shares before gift is to be multiplied 18 per share, and 60,000 into 18 per share is giving you 1080 and 000, 10,80,000. Whereas after this gift, from 60,000 he gifted 15,000. Remaining number of shares are 45,000. And if company share capital is 100,000, and after gift he owns 45,000, represent a 45% shareholding. According to 45% shareholding, value of each share will be 10 per share. So after this transfer, the remaining shares worth is 10 per share. In total 450,000. And if we deduct 450 from 1080,000, so we just end up with the calculation of the value of gift, value of PAT, value of 15,000 shares. That is a difference of these two values, which is becoming 630,000. As examiner is asking you to tell about the immediate implications under both heads of taxes. From this value of PAT, we can deduct the annual exemption of the current year. Annual exemption of the current transfer year is 21-22. So annual exemption of current fiscal year will be deducted first. Annual exemption is available 3,000, and thereafter the previous year annual exemption can also be brought forwarded. And normally we do study a rule. If about previous year annual exemption is, if nothing is mentioned about previous year annual exemption, assume as it's not consumed as, and assume it's available. Do also deduct the annual exemption of the previous year. If nothing is mentioned about for the previous fiscal year annual exemption, do consider as it is available. After this deduction, net PAT value is calculated as 624,000 from 630,000. If we deduct these two figures, so net PAT value is calculated as 624,000. Furthermore, as examiner is asking you to highlight the immediate IHT implications, so we can say that PAT is exempt. PAT is exempt at time of transfer. So that basically the immediate implication. So there would be no IHT on this PAT at time of transfer. So that's the immediate implication. But for your recalling purposes, I can tell you further points, but not linked with the requirement of this specific question. But we know one thing, that this PAT will become taxable if transferor dies within the 7 years after this transfer date. He is transferring this asset on 4th May 21. If he dies within the next 7 years after this date, if he's gonna die within the next 7 years after the transfer date, then this PAT will become taxable at time of death. But a taper relief would be available to cover. But for availing taper relief, there should be a minimum time gap of 3 to 4 years for getting this exemption, for getting this taper relief. But as the examiner has simply asked you to tell about the immediate IHT implications, so first of all, we calculated the net value of PAT by considering the diminution in estate concept. Then we concluded a single point: there is no immediate IHT on this PAT because potentially exempt transfer is an exempt asset at time of transfer. The same question is asked for immediate CGT implications. For CGT implications, we can conclude few points as: this asset, this is a transfer, as father is transferring this asset to son. Son is a connected person for CGT purposes, so we can write it as this is a transfer of asset between connected persons, between father and son, which are the connected person for CGT purposes. This is a transfer of asset between the connected person for CGT purposes. And next point, at time of transfer, any asset between connected persons is always recorded. It will always be recorded at its market value. HMRC asks you to record that asset which is in between, that transfer in between the connected person. It will always be recorded at market value, and market value which is how we can calculate the market value, which is, what will be the market value? Let me tell you how many shares are transferred. The 15,000 shares are transferred to son. If the 15,000 shares are transferred, what is the market value of 15,000 shareholding at transfer time? So you can see that for CGT purposes, if a person is transferring 15,000 shares, that represent a 15% holding of the company, and for 15% holding of the company, value of each share can be considered as 8. So simply multiply the 15,000 number of shares with the 8 per share value, So the market value of these shares is calculated as 120,000. So that is a, for CGT purposes, it's a transfer between connected person. It will always be recorded at market value, and market value at transfer time is 120,000 based on the 15,000 number of shares. 15,000 means 15% holding of the company. Based on the 15% holding, price of each share would be considered as 8, and 120,000 is the value calculated. Furthermore, we know one thing, that for CGT purposes, this gain, any taxable gain, may be claimed under a relief named as gift holdover relief. But for claiming gift holdover relief, there are certain conditions to be met. The asset should be the business asset, and the gifter and giftee both should agree to claim the relief. And if the gift holdover relief will be claimed, no immediate capital gains are taxed. Basically, gift holdover relief is a tax deferral relief, which is not gonna save tax in actual, but gonna defer the gains for the future time period. So hopefully all of the things under this scenario are clear. Are you guys okay? Are you guys okay? If you guys are okay, please do let me know. Yes, Jody, I can repeat with respect to CGT. As the father is transferring 15,000 shares to son, there's a transfer between the connected persons. And for CGT purposes, the transfer between the connected person is always recorded at market value. But how to determine the market value of these 15,000 shares? You can see that according to 15,000 shares, which represent a 15% holding, and worth of each share will be 8. 15,000 into 8 is going to give you 120,000. That is a market value. And let's say from these shares, what are the next calculation steps? From the disposal proceed amount, which is 120,000 for CGT, from the disposal proceed, we'll deduct the cost. From disposal proceed, we'll be deducting cost. So the gain amount is calculated. Then that gain can be relieved by deducting a relief. The relief name would be gift holdover relief. But for claiming gift holdover relief, there are two conditions that should be met. Number one, the asset should be the business asset. Number two, the gifter and giftee, or the seller or buyer, both persons should agree to claim the relief. But over here, I'm not going to tell further things with respect to CGT, because examiner is asking you to discuss the immediate IHT and CGT implications. Immediate means the quick, the implications right after the transfer under both of the heads. So we just discuss those relevant steps. Is that fine now? Judy, is that fine now? Okay. After 10 minutes break, I'm going to start next question that is very, very much important for all of us. Question number 5 is about the investment alternative. It's a very detailed question which I'm going to discuss after a few minutes. It's a 10 minutes break. After that, I will be starting this question. Welcome back. All right. So the next scenario is about the investment alternatives. It's basically question number 5 of this handout. It's about investment alternatives. Outline the tax implications of each of the investment alternative. Examiner is asking you to outline the tax implications of each of the investment alternative. Keep remember, in such type of requirements, you are not required to calculate that which option is better or which option is not better. For such questions, when the requirement is open, as in this scenario, outline the tax implications of each of the investment alternative. So just tell about the tax implications of each of the investment alternative. Just tell about the tax implications for each option. Don't compare that what is better or not. Which one is better or not, that is not required in this question. So you just need to highlight the tax implication of each of the investment alternatives. Read this scenario very carefully. T has recently inherited the residue of his aunt's estate. He will use this inheritance for the following purposes. There is a person named as Tobias. He just received the inheritance from his aunts at time of aunt's death, and now wishing to invest that inherited estate for multiple purposes, and there are multiple alternatives. Alternative 1 about the personal pension contribution, alternative 2 is about the gift to daughter, and alternative 3 is about the individual saving account. So you are required to outline the tax implications for each of the investment alternatives. Let's talk about number 1, which is personal pension contribution, one of the most favorite area of the examiner. I repeat, personal pension contribution is the most favorite area of the examiner. So examiner may ask multiple type of questions from this personal pension contribution. Personal pension contribution, when the person, let me recall few things, when the person is contributing, that amount is a net amount, but for tax implication, we always use the gross amount of the personal pension contribution. How we can calculate gross amount? For example, if you contributed an amount of 5,000, your contribution would be considered as an 80% amount. To make it gross, if 5,000 is a net amount, its percentage in its value in percentage terms is 180%, and to convert into a gross amount, so 5,000 is simply divided by 80% into 100%. So if we divide 5,000 divided by 80 into 100, that is going to give you 6250. So the person contribution is a net amount. However, we shall be using a gross amount for all of the tax implication with respect to the personal pension contribution. And if a person contributes into a personal pension, it basically impacts two things. The personal pension contribution is normally used in the calculation of the tapering of personal allowance, where we actually compare the adjusted net income with the income limit of 100,000. And for such calculation of ANI, from the net income, we deduct the personal pensions contributions gross amount. And due to this personal pension contributions gross amount, the basic rate band limit of 37,700 and the high rate band limit of 150,000, both band limits are increased by the gross amount of the personal pension contribution. So you keep remember, personal pension contribution is basically used in two calculation, in the calculation of ANI and also with the gross amount of the personal pension contribution. The basic rate and high rate band limits are extended. These are the general points with respect to the PPC or gifted donation, the personal pension and gifted donation. I just recall the relevant points, but what exactly is this scenario? Read the scenario very carefully, and then thereafter we can outline the tax implications. I'm giving you 1 to 2 minutes time to read this para and try to conclude few points in your mind, or you can write in on a paper. So then I will be discussing all these in very much detail according to this alternative one, the personal pension contribution. Your time starts now. Okay. T is a person who recently received inheritance at time of aunt's death, and now wishing to make the following, wishing to use the inheritance for the following purposes. And in alternative one, he would be using this amount for the personal pension contribution, and T will make the maximum possible amount of additional tax relievable personal pension scheme contribution for this tax year 21-22. Why I have circled this word, the reason why I have highlighted this word, because this word shows that he has already contributed into personal pension fund, and T will make the maximum possible amount of additional tax relievable personal pension contribution. The word additional shows he has already made a pension contribution in this fiscal year 21-22. Having already made contribution of 10,000 during this tax year, he has already contributed an amount of 10,000 into personal pension, and now wants to additionally make few amount in pension contribution. His adjusted income for the tax year of 21-22 will not exceed an amount of 240,000. We have studied somewhere this concept that when the adjusted income of the person is more than the limit of 240,000, this is given by 240 is given by HMRC, then 40,000 of annual limit of PPC starts tapering. When the adjusted income is more than the amount of 240,000, when the adjusted income is more than this amount of 240,000, then 40,000 of annual limit for personal pension contribution starts tapering. But as you can see, it is clearly mentioned that his adjusted income for this tax year will not exceed 240,000 limit. It means if this amount is not exceed, then this 40,000 is not to be tapered. For this fiscal year, annual limit is available 40,000. It will not be tapered anymore. And in this 40,000 amount, we can also add previous 3 fiscal years unused annual limit. I repeat, in this 40,000 of current year annual limit, previous 3 fiscal years annual limit can also be added. Furthermore, T has been self-employed since 6 April 19 and has been a member of the personal pension scheme from the tax year 2021. This statement is very important for us as we are talking about we can brought forward the previous 3 fiscal years annual limit, but for taking that annual limit, but before taking that annual limit, please do check whether the person was the member of the pension scheme or not. And it is mentioned that he was not, he just joined as he has been a member of the personal pension from this tax year, not from the previous tax years. Okay, this statement is going to help you out for finding the specific limit of the pension contribution for the fiscal year 21-22. How we will be checking that? Please wait for the things. T is trading profits and gross personal pension contribution since he commenced his self-employment have been as follows. He started business in 1920, trading profits were 32,000, but not contributed any amount in the pension fund. In the next year, he got the profits of 44,000 and also made a pension contribution of 26,000. And in the current fiscal year, the profits are 78,000. And in this year, he has already contributed an amount of 10,000 in the pension fund. So basically, for the fiscal year 21-22, for personal pension contribution, for each year, we do calculate a specific limit. If a person do contribute to the extent of this specific limit, then the person would not be having an annual allowance charge. If the person's contribution is less than the amount calculated as per the specific limit, if the person's contribution is less than the specific limit, then there would be no annual allowance charge. But if the person's pension contribution will be of more than this specific limit, then on the excess amount, then on the excess contribution amount, there will be a charge named as per annual allowance charge. But he wants to know that how much additionally he can contribute, so it will be tax relievable amount, means the person wants to avoid the annual allowance charge. How to calculate this is specific limit? Fiscal year 21-22 limit is available 40,000, and it is available as 40,000 because no tapering is applicable. Although this amount is subject to the tapering, but as a person's adjusted income is not more than this 240,000, so then this 40,000 amount will not be tapered. So we can conclude, we can take the whole amount and considering the previous 3 fiscal years. In the current year annual limit, previous 3 fiscal years unused annual limit can be brought forwarded, but I'm going to cross these 2 years directly. Why I have crossed these 2 years directly? Because he was not member of the pension scheme till this year, till 1920. He has not contributed an amount in the pension fund, so we cannot take any unused amount here because a person was not member of the pension fund. He started contributing from the fiscal year 2021, so then we can use an unused amount over here. But how to calculate that unused amount? For each year, for pension contribution, each year limit is 40,000, and if he has contributed an amount of 26,000 in this fiscal year, if he has contributed an amount of 26,000, it means the remaining amount, the unused annual limit from the previous fiscal year, is calculated as 14,000, and the specific limit for this fiscal year 21-22 is calculated an amount of 54,000. But as evident from the scenario, he has already contributed an amount of 10,000 in the same fiscal year. So how much he can additionally contribute? So we can deduct is that personal pension contribution already made in fiscal year 21-22, it is amount of 10,000. How much he can access? The remaining limit available is the value of 44,000. So if the person would be making additional amount to this extent, then that's fine, it will be a tax relievable personal pension contribution. But if the person would be contributing more than this limit, then on the excess amount there would be a charge named as annual allowance charge. So we can write it this as, if T makes further contribution to this extent of 44,000, then there would be no annual allowance charge. That's it. As he asked you that about the alternative one, if you would like to contribute in the pension fund, that would be tax relievable. So you can say that the tax relievable personal pension contribution amount is 44,000. If the T is would be making contribution to this extent, then he would not be getting any charge, and then he can simply avoid the annual allowance charge. My dears, is this thing clear, please? Waiting for your active responses. From this scenario, is this thing clear? All right, thanks for your replies. As T inherited estate from aunt's death, at time of aunt's death, now wishing to invest that amount for the following purposes, and we discuss the implications as we are required to outline the tax implications of each of the investment alternative, and we just concluded our discussion with respect to the first alternative, that is personal pension contribution. Now, alternative 2, gift to daughter. T will make a cash gift of 100,000 to his daughter when she gets married on 29th March 22, which is in the fiscal year 21-22. He has not made any previous lifetime gifts. So basically, from this scenario, for which taxes it is pertaining? Rukshan, can you please answer whether this scenario is pertaining to capital gain taxes or the things are like pertaining to inheritance tax? Can you please answer this question? Yes, it's pertaining to IHT. If he would like to give an amount of 100,000 cash to daughter at time of her marriage, so for IHT purposes, an asset which is transferred in life to any other person, for IHT purposes, that asset is considered as potential exempt transfer. So PET is of 100,000. But we know one thing, that there is always an annual exemption available for IHT purposes. Annual exemption of this year in which the asset is being transferred to other person, annual exemption for this year is deducted as 3,000. Whereas, as I told you in previous question as well, if nothing is mentioned with respect to the previous year annual exemption, assume it is available and we can deduct that amount as well. And when taking the annual exemptions, do deduct the current year annual exemption at first priority, then the brought forwarded annual exemption. I repeat, when to deduct the annual exemptions, if both years annual exemptions are available, then on a first priority, do deduct the current year's annual exemption first, and then the brought forwarded annual exemption. You cannot use like this. You cannot deduct the previous year annual exemption first. No, you cannot do like that. Current year annual exemption. For which year I'm using the word current year? The year in which the asset is being transferred, that is fiscal year 21-22, deduct the annual exemption of this year first, then the brought forwarded annual exemption. Furthermore, if you remember from the IHT knowledge, if you remember few points from the IHT, when a person is giving an asset, is transferring an asset, is gifting an asset at time of children marriage, so another exemption can be claimed named as marriage exemption. And marriage exemption is available 5,000 per parent and 2,500 per grandparent and 1,000 for by any person. So you can see that father T, being father, is transferring this amount of cash to his daughter at time when she is getting married. So marriage exemption can also be claimed as this amount is given by a parent. So 5,000 of the marriage exemption is available. After deducting all these values, the net PT value is basically calculated 89,000. I repeat, 2 years annual exemption deducted, and furthermore, as the asset is being transferred at time of marriage, at time of his daughter marriage, so another exemption, that is marriage exemption, can also be claimed, and the marriage exemption amount is 5,000 per parent. After all these deductions, net PT value is calculated as 49,000. what will happen then? We'll say that as it's a PET, this PET, this potentially exempt transfer is exempt at transfer time. For with this amount we are talking about, this PET is exempt at transfer time, but will become taxable, if T dies before, what is the transfer date? That's the transfer date. Count the 7 years time period from 29th March 22. If you do count 7 years time period, that's becoming 29th March 2029. So this asset will become taxable if T, if the transferor, if the father, if the person who transferred this asset, which is T in this scenario, but this asset will become taxable if T dies before 29th March 29. In effect, within 7 years, after the transfer time, transfer date is 29th March 22. And if he dies within 7 years, this asset will become taxable. However, then a taper relief would also be available. If any lifetime asset which is becoming taxable at time of death due to 7-year rule, then a taper relief would be available. But for claiming this taper relief, there is a condition that minimum time gap between the transfer date and the death date should be of 3 to 4 years. If the person dies within the next 1, 2, or 3 years, then this taper relief would not be available. For claiming this taper relief, the minimum time gap between the transfer date of asset and the death date of the transferor should be 3 to 4 years at least. Then the taper relief would be available at 20%, and it will be increasing. If the time gap is getting more and more, the taper relief percentage will also be increasing according to the time gap. If T survives, now the second scenario, if T survives after this date, after 7-year date, like after 29th March 29, so we can write if T dies after 29th March 29, then this PET will remain exempt at time of death. Why? What is the reason of being exemption of this asset at time of death? Because now the person have survived for at least 7 years after the transfer date, then this asset is automatically exempt at time of death. Is this thing clear, all of you, please? So these are the implications, the tax implications under alternative 2, when he is gifting an amount of cash to his daughter at time of when she was getting married. So these are the relevant tax implication. Are you guys okay with all these discussions? In case of any unclarity, any disagreement, you may please ask, you may raise your voice. Okay. Thereafter, let's talk about this alternative 3 about individual saving account, ISA. I want to listen from your side. What is ISA? Any idea about it? Anything which you remember with respect to these ISAs, individual saving accounts? I want to know a few points from your side, please. Okay, what else, please? Yes, there is investment limit in such accounts is 20,000 each year, available to each person individually. Yes, that's fine. What else? Okay. That's pertaining to the savings income, right? There is 1,000 exemption at time of when there is taxable saving income, that is exempt up to 1,000 if the person is basic rate taxpayer, and 500 from saving income is exempt if a person is a higher rate taxpayer, and there is nil amount exempt when a person is an additional rate taxpayer. That's a separate discussion. That's for the taxable saving income. But over here, generally speaking, ISA is the investment from individual saving account. Any interest income, any saving income which a person is getting from the investments in ISAs, that is simply exempt from taxation. But it is exempt to some extent to a specific limit. After that specific limit, it will start becoming taxable, and then we can apply these savings exemptions according to the status of taxpayer. The basic rate taxpayer would be having an exemption of 1,000 on the saving income, and the high rate taxpayer having an exemption of 500 of saving income. But this ISA has few separate points to discuss, and I would be discussing these relevant points while reading the scenario. T will invest maximum possible. Again, there is a word additional. This word shows that he has already made an investment in this ISA and now wishes to make additional amount. He will invest the maximum possible additional amount into an individual saving account for this tax year 21-22, which starts from 6 April 21 and ends on 5th April 22. He has already invested an amount of 5,400 into cash ISA during this tax year. Having previously invested 6,200 into a cash ISA during the previous tax year. By the way, previous tax year investment has nothing to do with this current year investment. There is each year investment available. If he has previously contributed an amount of 6,200 in previous fiscal year 2021, that has nothing to do with this current fiscal year 21-22. But this amount, as he has contributed this 5,400 into this year already, so that's relevant for us. So let me guide few points. ISA investment limit is £20,000. ISA investment limit is £20,000 for fiscal year 21-22, and a person can invest either into a cash ISA or a stock ISA. So basically, these are two types of the ISAs. ISAs are divided into two types. One of the ISA is cash ISA. Another one is stock ISA, also termed as shares ISA. So a person, it's on the discretion of the person that in which ISA, in which type he is gonna invest. There is no restriction. A person can invest an amount of 20,000 either in cash ISA or stock ISA. To the extent of this investment, there would be no tax implications. Any amount, any interest income in return to the extent of 20,000 investment, if there is an interest income received, that is exempt from taxation, as he has already invested 5,400 pounds in fiscal year 21-22, in fiscal year 21-22, hence can further invest, because it's asking about the additional, so we can say that hence can further invest an amount of 14,000. Where from we are getting this 14,000? Because annual investment limit is 20,000, and he has already invested an amount of 54,000. In fact, he can further invest an amount of 14,600 either in cash ISA, or stock ISA. There is no boundness on the person. It's on the discretion in which type you want to invest. Any return means the interest income. Any return, the interest income from ISA would be exempt from tax if he made investment within the allowed limit of 20,000. So that's the allowed limit for each year. And if a person is investing to this extent, any return, any interest income on this investment, there is no taxation if investment amount in ISA is more than the allowed limit, then the interest income on excess investment will become taxable as normal savings income. And then we can say that furthermore 1,000 or 500 saving income exemption would be available according to the status of taxpayer. I can guide you with respect to few examples. Let me consider, for example, person invested 18,000 in ISA and interest percentage is 10%. It means 1,800 he received as interest. This 18,000 is less than 20,000 allowed limit, so this 1,800 is simply exempt. Furthermore, another example, let's say person invested in ISA 20,000 and let's say interest rate is 10%, he would be getting 2,000. As you can see that this 20,000 is less or equal to 20,000 allowed limit, so the interest received is exempt. For example, now person has contributed 25,000, allowed limit was 20,000. What is the excess contribution? 5,000 excess. 5,000 is the excess. Again, assume interest rate is 10%. So this 2,000 of the interest income will become exempt. Why? Because it's in between the allowed limit, and any interest income which received on the excess contribution, excess investment, that is 5,000 into 10% is becoming 500. This will become taxable. So that's the point we have marked above. If investment limit in ISA is more than the allowed limit, as you can see 25,000 is more than 20,000 allowed limit, then the interest income on the excess investment, and excess investment was 5,000, then the interest income on the excess investment will become taxable as normal interest income. Till to the extent of this amount, it's still exempt, but any investment income on the excess investment will become taxable. Are you guys okay with respect to the ISA's discussion? Yes, my brothers. Are you guys okay? Good to know it. By the way, I have already shared this handout in the relevant WhatsApp group. So we are having further two questions, the question 6 and question 7. I'm not going to cover these questions. Basically, I'm skipping these two questions for you guys. You can attempt these questions at your own and then can ask for the solution of these questions. I would be sharing the PDFs, but I would request you to attempt these questions at your own first, then to ask for the answers and compare your answers with the standard answers provided. After these two questions, on the next slides, we have few comparisons like consequences of employed and self-employed. If you are doing job and if you're doing your own business, so what are the consequences? So here you have few points in the summary form, and on the next slide we have attached this slide, scope of capital gain taxes. So again, you would be having all these points in a summary form, so these are going to help you out while preparing your actual exam. So I'm going to conclude today's session. In case of any question, query, discussion, you may please write in the relevant WhatsApp group. So we shall be responding you there. And thanks for your time. Thanks for joining this session. Again, I just left these two questions for you guys, and I would really appreciate if you try to attempt at your own and then can ask for the answers of the same questions. Thank you very much, and thanks for joining this session. Thank you for your time. In case of any question, any disagreement, you may please write, and I would be answering to your questions. I would happy to answer your questions. And in case if you guys are okay, then we can conclude it. And I'm wishing very much good luck for your exam, and my prayers are with you. May God bless you. And again, very good luck for your exams. Thank you. You're welcome, my dears. Thank you. Stay blessed. Take care, and Allah Hafiz.